This channel opened its archive with the Fontainebleau Miami Beach. Case File 001 documented a construction loan that collapsed when a pre-leasing covenant became unachievable in a contracting credit market, leaving a 68-story tower with wet concrete on the upper floors and no mechanism to advance additional draws. That case established the forensic framework that the 14 case files following it have applied to hotels, casinos, resorts, and grand historic institutions across the United States. Case File 015 returns to the same name, the same developer, the same credit cycle, and the same outcome, in a different city. The Fontainebleau Las Vegas was a separate project from the Miami Beach expansion, conceived independently, financed independently, and located 3,000 miles from the Atlantic coast. It was also, in every forensic dimension that this channel's analytical framework measures, the same case, the same developer, the same market timing, the same capital structure vulnerability, the same credit cycle collapse, the same result. The symmetry between the two Fontainebleau failures is not coincidental. It is the most precisely documented example in this channel's archive of a developer whose relationship with construction financing produced identical outcomes at scale, in different markets, simultaneously, during the same 18-month window of credit contraction. The Fontainebleau Las Vegas was a 64-story hotel tower on the northern end of the Las Vegas Strip, at the site of the former El Rancho Hotel, designed to contain approximately 3,800 hotel rooms, 350,000 square feet of meeting and convention space, a casino, and a retail and entertainment complex of a scale that had no precedent in the Northern Strip's development history. The project was conceived at the peak of the mid-2000s Las Vegas hospitality expansion cycle, when the Strip's northern corridor was being repositioned as the next frontier of megasort development following the saturation of the central and southern Strip with properties that had absorbed the capital available for that generation of development. The project broke ground in 2007. It stopped in 2009. The gap between those two dates is the forensic subject of this case file, and the gap between this case file and Case File 001 is the forensic argument. The same name, the same developer, the same crisis, the same failure, in two cities at the same time. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The Fontainebleau Las Vegas was financed through a construction loan facility that at its peak commitment reached approximately $1.85 billion, an amount that made it one of the largest single construction loans in the history of Las Vegas real estate development. The loan was assembled by a syndicate of lenders that included Bank of America, J.P. Morgan Chase, and a group of institutional participants whose collective underwriting of the facility reflected the credit environment of 2007, when the Las Vegas luxury hospitality market was still operating at a trajectory that made the project's revenue projections appear achievable. The covenant structure of the Fontainebleau Las Vegas construction loan shared the specific vulnerability that Case File 001 documented in the Miami Beach facility, a sequential draw structure contingent on the project meeting milestones of physical completion and pre-commitment from commercial tenants, retail operators, and convention customers whose willingness to commit was itself a function of the credit environment in which the project was being built. When that credit environment contracted in 2008, the pre-commitment threshold that the draw structure required became unreachable for the same reason it had become unreachable in Miami Beach. The parties who were supposed to provide the pre-commitments were themselves facing liquidity constraints that made any new commercial commitment impossible regardless of the underlying quality of the asset being built. The forensic parallel between the two Fontainebleau failures is documented with a precision that this channel has not previously encountered across 14 case files. The Miami Beach facility had a retail pre-leasing threshold in Section 4.2 of its loan agreement. The Las Vegas facility had a convention pre-booking threshold in its draw schedule that required the project to demonstrate a minimum level of group and convention business commitments before the final tranche of the construction loan could be funded. A hotel tower under construction cannot have convention bookings. A convention facility under construction cannot demonstrate the occupancy history that convention customers require before they will commit to a booking. The covenant was written for a completed asset. It was attached to an asset that was not complete. In both cities, the same structural impossibility produced the same outcome. The draw schedule froze. The labor stopped. The carrying costs continued. The developer filed for Chapter 11 protection in June 2009, the same month that the Miami Beach project entered receivership, a simultaneity that the forensic record documents with the precision that no coincidence theory can adequately explain. At what point does a developer's repeated use of the same covenant structure across multiple projects in multiple markets constitute a pattern of institutional negligence rather than a sequence of bad luck? Leave your analysis in the comments below. The appraisal methodology applied to the Fontainebleau Las Vegas at the time of the construction loan origination shared the three-input failure pattern documented across this channel's archive with the specificity that makes the Las Vegas case the clearest laboratory example of that pattern in the full 14-case collection. The first input was a stabilized revenue per available room projection calibrated to the peak of the mid-2000s Las Vegas luxury hotel market, a market that had been driven by the combination of a national real estate boom, the expansion of the Las Vegas convention and trade show calendar, and the specific demand dynamics of the Northern Strip repositioning that the project had been designed to capitalize on. The second input was a capitalization rate reflecting the compressed yield environment of 2007, when institutional investors were pricing Las Vegas luxury hospitality assets at yields that treated the Strip's growth trajectory as indefinitely sustainable. The third input was a construction completion timeline that assumed uninterrupted draw availability through the project's scheduled completion date in 2010. All three inputs collapsed simultaneously in 2008 and 2009. The revenue per available room projections became unreachable as the national recession eliminated the discretionary travel and convention spending that the Las Vegas market depended on. The capitalization rate expanded as institutional investors required higher yields for real estate assets of all categories in the post-crisis environment, and the construction timeline became unachievable when the draw schedule froze following the lender syndicate's withdrawal of the final tranche commitment. The appraisal failure at the Fontainebleau Las Vegas is forensically interesting not because it was unusual, but because it was the second iteration of the same appraisal failure at the same developer's project in the same credit cycle. The Miami Beach appraisal had made the same three-input error with the same three simultaneous corrections producing the same outcome. A developer who had experienced that sequence in one market and continued to build a capital structure with identical vulnerabilities in a second market during the same credit cycle had either not incorporated the lessons of the first failure into the second project's financial design or had incorporated them and determined that the risk was acceptable at the return the project offered. The forensic record does not resolve which explanation is correct. It documents that both projects failed by the same mechanism in the same 18-month window, and that the mechanism was visible in the covenant structure of both projects before either project's draw schedule froze. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The developer's public posture toward the Fontainebleau Las Vegas construction stoppage in 2009 followed the pattern documented in the Miami Beach case with a symmetry that extends beyond the financial mechanics of the two projects to the communication strategy employed when each project's draw schedule froze. In both cases, the developer characterized the construction stoppage as a temporary disruption caused by lender dysfunction rather than as a structural consequence of a capital structure that the credit environment had rendered inoperable. In both cases, the developer pursued litigation against the lender syndicate alleging wrongful refusal to fund draw requests that the developer characterized as fully compliant with the terms of the credit agreement. In both cases, the courts did not provide the relief the developer sought. The architecture of denial in the Las Vegas case has an additional dimension that the Miami Beach case did not contain: the Las Vegas project had been conceived and capitalized during a period when the Miami Beach project's difficulties were already visible in the construction lending market. The credit environment that made the Las Vegas draw schedule vulnerable had been developing for more than a year before the Las Vegas draw schedule froze. A developer with visibility into the Miami Beach project's lender negotiations had access to real-time information about the specific covenant vulnerability that the Las Vegas project shared, and had the operational ability to restructure the Las Vegas facility's draw requirements before the credit contraction made restructuring impossible. That restructuring did not occur. The Las Vegas project continued on its original draw schedule until the schedule froze, at which point the developer pursued the same litigation strategy that the Miami Beach project had pursued, with the same judicial outcome. The parallel is not limited to the financial mechanics. It extends to the response, which was identical in structure if not in precise detail, suggesting that the developer's institutional approach to construction loan defaults was as systematic as the developer's institutional approach to construction loan origination. The Fontainebleau Las Vegas was purchased out of bankruptcy by Carl Icahn in 2010 for approximately $150 million, a figure that represented approximately 8 cents on the dollar of the construction investment at the time of the filing. Icahn held the asset for 3 years and sold it in 2013. The tower that had been designed to contain 3,800 hotel rooms stood incomplete for 15 years before its most recent owner committed to finishing it. The Fontainebleau Las Vegas was ultimately completed and opened in December 2023 under the ownership of a group that included Koch Industries and other institutional investors who had acquired the asset and committed to a completion budget that the original construction loan had never funded. The completed building opened as the Fontainebleau Las Vegas, retaining the name that had been associated with the project's failure for 14 years, under a capital structure designed for a completed operating asset rather than for a construction project in a contracting credit market. The opening in December 2023 came 33 years after the original Fontainebleau Miami Beach had been rebuilt following its own collapse, 16 years after the Las Vegas groundbreaking, and 14 years after the construction stoppage that left the tower unfinished on the northern strip. The building that Carl Icahn had acquired for $150 million in 2010 opened at a total project cost that its current owners have not publicly specified, but that independent analysts have estimated at between $3 billion and $4 billion, a figure that would make it one of the most expensive hotel projects ever completed in the United States. What the Fontainebleau Las Vegas case reveals in the context of this channel's full archive is the specific compounding risk of a developer whose institutional approach to construction financing produces the same vulnerability across multiple projects in multiple markets. Every other case file in this archive has documented a failure specific to a particular asset, a particular location, a particular credit cycle, or a particular ownership structure. Case file 015 documents a failure specific to a particular developer's relationship with construction lending, a relationship whose pattern was visible across 2 projects in 2 cities, and was not interrupted by the failure of the first project before the second project reached the same structural endpoint. The Fontainebleau name has now been associated with the same failure in 2 cities, the same construction stoppage in 2 markets, and the same eventual completion in both locations after different ownership groups resolved the financial complexity that the original developer had left behind. The marble in the Miami Beach lobby was stripped before the Las Vegas tower was completed. The Las Vegas tower that replaced it has marble of its own. The pattern that produced both failures also produced both resolutions. The buildings are finished. The lesson is not. If this case file and case file 001 together changed how you evaluate construction loan covenant structures across multiple projects from the same developer, subscribe to this channel, because the next case examines what happens when the building is perfect and the market simply never arrives. And in the comments, given the documented parallel between the Miami Beach and Las Vegas covenant failures in the same credit cycle, what specific regulatory or underwriting mechanism would have identified the systemic risk before the second project's draw schedule froze? The case file is open.